Hey guys, Mike here. So what an exciting day in the market, or not really, right? Because what's happening at the end of the month, those who don't know, especially the last day, is a lot of the funds, the pension funds, things like that are reallocating, right? So they're trying to sort things out before we start March. And so, sometimes, a lot of times, you won't have any crazy movements on the last day, right? Unless something funky is happening and everything. And that's why, when we go into it, I'll show you what I'm talking about. I was very surprised what I told the members this morning actually held up. When it comes to the range I put out for them, it was a very tight range, but shockingly, it did. Now, some data came out, and I think this took a lot of people off guard. I know it really surprised me. Let me know in the comments if you were surprised. But it was U.S. pending home sales surge, topping all estimates, which, I mean, if you look, that's a pretty big jump, right? We hadn't seen that since back in 2020. So it's been a while. Now, understand, this is pending home sales. These people have to go through with these purchases. And so we'll see, because you know how it is when you're trying to close, and they go, well, here's the final numbers, and you go, what? How much I got to pay every month? So we'll see if that continues. They actually closing all these deals. But what was really surprising about it, again, a lot of people are having trouble qualifying because one, don't have the income for it, because the debt to income is thrown off now with how expensive things are with the rates and everything else. The other thing is, some people's credit scores are getting dinged, because look at what's happening with credit cards right now in the 90+ day delinquency. This is the really bad one, right? You see the young folks. That's a pretty decent sized jump, and of course the baby boomers are good. They're paying their credit cards off, right? Now, that brings me to this right here, and this just came out last night, and it's changing household savings. And you can see for the first time it went positive, right, since 2021, like all the way back in like June or something. And you can see right here, it's like $1 trillion. I mean, it's a lot of money in savings. Now, again, this can be thrown off by just a few rich folks' accounts, right? Because we know like 3 people in America are worth the next 292 million people. And when you look at the top up there, if you look, it's been increasing for the last really 7 months, right? It's been coming back out of that little negative area and improving slightly for the last 7 months. Now, why is this? And of course, to me, one reason this has been happening is, remember, they're taking just the look at the account, right? The total account values, right? And don't add them all together. It's because people for the first time in 15 years are drawing between like 3 to 4.5% interest on their money, right? And you're talking about accounts around obviously the country, and you saw there's $1 trillion worth, right? So you're drawing 3 to 5% or 3 to 4%. Hey, that's nothing. That's not nothing, I should say, right? That's something. And so I think that's helping out with the saving as well. But then that brings us into, what we got to look forward to. And I showed you something like this. This is a different chart. This is bankruptcies of companies with $50 million more in debt, right? And now we're at this kind of line right here where you saw in the dot-com bubble, but what happened in 08? A lot more. What happened in 2020? A lot more. Of course, we shut down the world and the bank system almost fell to pieces, right? So did I expect that big a push up? No, but do we expect it to pop that line? Absolutely. And the reason why I think it'll get worse is simply because, and I showed some of you this, is the banking restrictions taking place, right? The standards as far as lending are getting harder and harder. And here's the reason why. Let's add the Fed's funds rate. That's why I think it's going to get worse. As the Fed funds rate goes up, let me go ahead and get this line for you. This continues to go up. You can see it. That's where we're at now. You can see right there. But you can see anytime it goes up, the lending standards get tighter and tighter, right? You go back to here, 08, same thing. So the lending standards started getting tighter a couple of years even before the recession ever hit. If a recession hits, then it gets really tight, because you become, or me, companies, everybody for that matter, become a much higher risk to default, and people don't want to give you money if you're a high risk at default. You can see the same thing happening right there. And so that's what we got to keep in mind. And guys, if you get anything out of this, please hit that like button. It really does help the channel. And if you're new here and you like this kind of content, think about hitting the subscribe button. I really appreciate it. And of course, the reason why this will probably get worse is, in the last 13 years, we've had so many zombie companies created. These companies that take on mass amounts of debt because they get it for very cheap, right? And then they keep rolling it over for very cheap. Well, that's gone. It's gone to the wayside. They're unprofitable, still aren't turning a profit, right? And so that's why you see that big peak I showed you. And yeah, of course, it should get worse. I think common sense was there. It says, yeah, it should get a lot worse, And so we'll have to look at that. And of course, that'll have to do with what? People losing their jobs. All right, usually when you're coming in with bankruptcy, depending on the kind it is, most time though you lose your job. That's what happens a lot of times. So we'll have to see on that and pay close attention to it. And plus, with that delinquency rate on the credit card, understand where it started from. Like I look at the big thing. I update you guys like every quarter, which I'll update you after March, showing the delinquencies on all houses and everything else. And I've showed you before, it is very, very low, right? Even compared to the norm, just because of all the free money handed out. I mean, I got to do my taxes, so I was doing that yesterday with the accountant, and even she was telling me about it. It's all this free money that got handed out, and so that's just helped a lot of people survive. She sees it, we all see it, and so all that money sitting in those bank accounts. And so, and the reason why I was saying that about the $1 trillion being skewed, because I remember I read a stat the other day. It's like the top 3 richest people in America, their wealth is worth the next like 292 million, or worth as much as 292 million Americans. I think we only have like 330 million in this country. And so, but I'm pretty sure it has to be. I didn't look at the people. I'm sure it's Warren Buffett, probably Elon Musk, and Jeff Bezos probably. But their wealth is worth, and it makes. I think about it. You think about it. It makes a lot of sense, right? If 90% of the country makes, what is it, 200,000 or below or something like that, yeah, that makes sense. I think it's kind of crazy that 3 people make up that much. But that's what I was saying on those bank accounts. I'd like to know, what income brackets are you looking at? Or are you just taking them all as a whole, right? Because if that's the case, again, a couple of accounts can just skew the heck out of it. I mean, that's the way you got to look at that. But I was telling you this morning, this is what I put out to the members, and it surprised me, was this range I put out. And again, it's based off the opening. It's based off what the options contracts are expiring and stuff, but 395 to 401. And so I was like, okay, well, this is going to be interesting because it's a tight range, but surprisingly, it held. But the one thing I didn't take into consideration was, yes, what's going on with funds today and reallocation and stuff like that. And sometimes you do get a quiet day, even though the ending wasn't very good. Nice little sell-off there at the very end. But again, it's like a 0.78% range from top to bottom, which in this market is nothing. I mean, we've seen how many multiple 1% swings, 2% swings. I mean, when you're looking at it. And again, we're just kind of sitting in this chop box range. We can't get above, that trend line again. We're still below that right there. Nowhere near the double top. We got the other trend line, which we're trying not to break through. We're sitting there with a 200 moving average, with the anchored VWAP, with that support line or trend line, as you say, just sitting all in one place, sitting at the golden pocket level. I mean, again, when you're looking at the options here, this is tomorrow, right? So this would be March 1st. Well, you got 400 calls, and then we're looking at 395 and 390 puts. So, of course, we're sitting right above 395 now. So, does the market makers want to pay out the calls, or are they going to pay out the puts? Or are they going to try to just jam us into a small range again? That's really going to be your big question, because the economic data doesn't really seem to be affecting us right now, because we had economic data come out today, and I mean, it wasn't good, right? But again, it just in a big way doesn't affect the markets, right? There's definitely other things that are driving this market more than what the data is, because especially the industrial data, it just continues to be bad, all right? Pointing towards recession, contraction, not expansion, that kind of stuff. And so, the one thing that came out today, and you're going to hear this a lot. And so historically, at no time since the inception of the S&P 500 has it closed above its 200-day moving average this long after a bear market low and go on to make lower lows. Not once. Now, I want you to understand the key to this is make lower lows. I went all the way back to the inception of the S&P to fact check this. I went through it. It doesn't mean it's not going to break down through the 200. It doesn't mean it ain't going to sell off. It has never set a new low after being this far above the 200-day moving average this long. Now, guess what? Records are made to be broken, baby. Okay? So this would absolutely be a first, because we've never seen this before. We've never shut down the world at any point in time during the S&P 500's inception, now have we? And so again, I look at it and go, I don't care if it breaks. I mean, who cares if it breaks and goes down an extra, 2%, 3%, 5%, whatever it is, But that's what people, who are holding out for that, or people who are worried about that. Again, it doesn't mean they're going to break the 200. Doesn't mean it's not going to go way down. Okay, I think to get to the lows will be another 8% on the S&P. So that means for stocks, it would be a lot more than that for a lot of stocks, for sure, especially the ones that hadn't even been hit yet. Okay, your Apples and Microsoft and stuff like that. So that's definitely something to keep in mind. But you'll see that floating around. Again, the longer it spins above the 200-day, it's not bearish. It is bullish. But when it breaks, yeah, you're going to see a nice sell-off most likely, because that is bearish. Does it mean we're going to set new lows? We'll find out, right? Just, get your popcorn, sit back and relax. And I'll show you what I'm talking about with the stock market being a soap opera, and I like to leave cliffhangers right here with Tesla's chart. What did Tesla do here? Tesla, kind of a quiet day for Tesla. Everybody thought it was going to rip and roar. But, it's sitting here right here just wedging its way between those trend lines, right? I mean, literally, look at that. I mean, that's crazy. That's the trend line coming down. That's respected quite a bit, right? Trend line coming up since the beginning of the year when it's been on this rip and roar and rally, broke down through it, went right back above it. Again, staying above 200. Can't get to 220. I mean, it just stays right there. But look at that right there, how it is wedged in there. And why is that important? As you get an even better look there, because right above it, you have the 200 EMA, and then you got the 200 SMA, right? Right above it. But more importantly, what's tomorrow? It is Investor Day for Tesla, right? So now, what are the odds of it being wedged in like that right before this? Again, it's a soap opera, right? We got to see because it's going to have to pick a motion. It's going up or it's going down. That's the way it is. And if you look at the options right here, is it finally going to break 220? They're finally going to pay out those calls, or to even 225. And here's the thing on Tesla, a lot more calls than puts for Tesla right now, which is important. Again, I just kind of laugh at that, and I'm like, Investor Day is tomorrow. Isn't that interesting? They put us right here in this position to see what happens, right? Again, a soap opera, a cliffhanger. That's where it is. So again, I don't know what Elon Musk's going to say. Sometimes this is a sell the news event. Suppose he's going to come out there and announce a cheaper Tesla or something like that, or who knows. And he's even trying to. He's getting smart. He's starting to use the word AI a lot. He's talking about starting a whole division or whatever. And so that worked for Meta and some other companies, just saying it over and over, and people go. And I actually looked this up. Like I was telling the members, this AI has been around since the 50s. Like they've been talking about this since the 50s, and all of a sudden, for some odd reason, it's been movies, and we've watched movies for years, growing up with artificial intelligence and robots and all this other stuff. And now everybody's like, it's like new. Like we don't even do anything with AI. It's like, we're gonna start doing stuff with AI. We already do stuff with AI. What are you talking about, right? But it's just this new thing. It's the new bubble. Time to pump it up, right? I mean, that's what this is. And I mean, again, bubbles can go on for a long time. So we'll see what happens. And that's why Meta popped today, because they're talking about AI, and Mark Zuckerberg is talking about it. And it's like, but you're already doing that. I mean, but it's this new thing. Now, going into this right here, I'm going to update this right here. And I'll try to update you from even more from now on in. But this right here, remember we talked about last week, here's your percentage of sectors and index members above a 200-day moving average. That's what I care about the most, 200-day moving average. And you can just see tech, right, sitting at 64 when we talked about it. Financials at 81, energy 43, utilities 31, NASDAQ 163, and then S&P at 63. And then we updated now, this came out today. We can see tech has dropped from 64 to 59. Obviously, you got financials going from 81 to 79, energy 43 up to 48. So energy actually went up, right? So pay attention to that. So that means people are rotating in there, right? And then you're sitting there going from utilities at 31 down to 28. And then jumping over the NASDAQ 100 and S&P, we're both at 63. Well, now they've dropped to 58 and 63 as people basically dump tech. And big money, whoever started rolling into energy, but also pay attention to healthcare. Healthcare actually dropped, which is kind of surprising, right? Because that's usually one of those defensive names people like to get into and stuff, because even in hard times, what do you need? Healthcare. People go to the hospital. That's the way it is. And I'll keep, let me know in the comments, but I'll try if you want me to keep bringing this to you, and we can kind of compare and see it, because you can just see what people are going into. The 200-day moving average is really important, right? Whether you're going above it or below it and stuff. And tech has definitely took quite a big hit, because it was actually in the 70s at one point in time. So again, because they're still trying to figure out and go, well, I guess the Fed's going to keep raising. I'm still waiting for Nikki Leaks to come out and drop some breadcrumbs on that one, or get a leak from the Fed, but we still got time on that, whether they're going to do a 50 basis point hike or not. That's why you see yields continue to go up, and as long as yields continue to go up and the dollar stays somewhat strong, guess what? That's a big headwind for the market. But then what you got to do is wait on that next time when the market says, okay, now they're going to pause, right? And then you'll get another type of rally for that kind of stuff. But, that's just the thing to watch out for. Is I think, there's a good chance the market really just tries to keep us in a range while we wait on the next Fed rate hike and stuff as we go through it. And you'll have your economic data, and they'll go, oh my God, it still looks horrible. Yep, still hadn't improved. How about that? Inflation still sticky, especially in the services sector. Nobody's, denying that one. But again, the market can be irrational. That's what it was in December, going all the way through January with the crazy stocks that were going up. Now they're going down pretty dang fast. But surprisingly, crypto's hanging in there, right? And a lot of people think that's because China's pumping a bunch of liquidity in the market, and they think they have something to do with that. I can't prove it, but that's what I've heard at least. Let me know in the comments what you think about that. And that's all I got for you. So if you got anything out of it, hit the like and subscribe button. I really appreciate it and appreciate your support. And I'll see you tomorrow for another busy day.